Hello, traders. This is Dave with the SPY Super System Software Options Trading Room. And I got something new for us to look at tonight. We're going to talk about a new strategy that I've been working on for a couple of months. Going to go over quite a bit of detail on it. So I hope you find it interesting and useful, and looking forward to trying to improve everybody's results trading. Okay, first thing I have to do, of course, is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose, and neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, just want to cover just quickly the strategies we use in the options trading room and on the alert service. These are the main strategies. We do straight calls and puts. We do straddles and strangles. Straddles and strangles are non-directional. We use debit spreads using weekly options expiration. Time spreads over earnings. This is another non-directional trade that we take advantage of the volatility crush that occurs once earnings come out. And we do this. We'll be doing this a lot here soon because we're going into earnings season. And we also have a weekly, what's called an ATM strategy. This is a strategy where we take a neutral to bullish stock. We sell puts against a strike week after week after week while holding a further out in time long put to protect ourselves to the downside. Been very, very, very successful strategy when you get the setups correct. They don't come that frequently, but when they do, they usually work very, very well. And you don't have to watch them all the time. It's fairly forgiving. And then we also do credit spreads to capture premium over a few weeks. Now, inside the room, we have a couple of intraday type strategies that we use. These are SPY Super System intraday strategies. These are for quick trades. 5 minutes, 10 minutes, 20 minutes, a half an hour maybe. But these are quick trades. And we have two methods now, two strategies. The first one is the SPY Super System, which we've had for about a year and a half, where we basically trade on the SPY, the Qs, the IWM, futures, or even some stocks, where we use the SPY Super System software to identify the setups that are advantageous for us to take. Now, these are in the money. When we take these are in the money options, and I distinguish that from what I'm going to talk about here in a minute. The trades on the SPY Super System should be in the money trades, right? Because it's different criteria. It's also got there's a lot more forgiving trades than what we're going to talk about here in a moment. The new trade that we've developed is called OOMCAT. All right, and this is for high momentum, high volume trades. OOMCAT stands for out of the money catalysts. All right, these are intraday trades. These are fairly quick trades. They're momentum based, and we're using out of the money calls and puts to maximize our leverage on these trades. And you get really big leverage on these when they work. Okay, now one of the reasons I'm actually introducing this right now is if you're a trader and you don't have $25,000 in a trading account, or you don't have a cash account, right now there's a thing called the PDT rule, pattern day trader, which means if you have less than $25,000 in your account, you can only trade intraday trades 3 times in a 5-day period. In other words, you can only take 3 day trades every 5 days. All right, if you don't have over $25,000 in your account. Now, the reason I'm mentioning this is because they've already approved the change in this for 2026. I don't know when it's going to happen yet, but it's going to happen relatively soon. And they're going to change this balance to roughly $2,000 sometime in 2026, which means now this is going to allow millions of new traders. They're going to suddenly gain access to intraday trading. All right, so this is a big deal now. You can intraday trade with futures because you're not subject to that. But futures are completely different than trading the stocks that we trade. For one thing, it's very difficult to trade futures. You don't have a relative strength and relative weakness to use, and it's one of the main criteria. So this shift is going to demand more fast, disciplined, momentum-based strategies. So we're adding the OOMCAT strategy now to prepare traders for a far more accessible, far more active market environment. Now we can use this now. I've been using this for a couple of months, and I'll show you exactly how it's worked out. We're going to go into some very specific detail on this. You have to be very, very cautious here, because out of the money calls and out of the money puts are generally not what I would recommend most of the trades I take. But this particular strategy, when the criteria is correct, these things work extremely well, and the profitability, the return on investment is much higher than it is in the regular trades. Okay, there's a little OOMCAT right there, out of the money catalyst. That's what this stands for. That's the symbol, the logo we're going to use for this, and I think it looks pretty good. Okay, so OOMCAT, this is something I want to, again, we're taking out of the money puts and calls. This is out of the mainstream for strategies that I've used and taught over the years. And again, although certain criteria within the strategy may appear unconventional when compared to traditional high probability trading methodologies, such as using out of the money as opposed to into the money, these deliberately refined distinctions are what set this approach apart. Okay, by integrating these counterintuitive elements with precision, the strategy unlocks a distinct structural advantage, consistently producing exceptionally high probability trade opportunities reserved for disciplined, informed traders. I emphasize this, disciplined and informed. You don't want to get into these without having a good discipline and be able to stick to the strategy very closely. But this is what OOMCAT is and why it's some of the criteria are going to seem odd, because if you've been trading with me for a while, I always use in the money 65 to 70 deltas for the puts and calls. I never chase stocks. In this case, there'll be situations where would appear we are chasing stocks. Okay, OOMCAT trading criteria. All right, so these are out of the money option trades based on a catalyst with specific criteria. We're going to be taking out of the money trades, but we have to have a catalyst that's driving that stock, right? And I'm going to go into quite a bit of detail on this, and then we'll show you some actual trades and the charts and how to use them. Okay, OOMCAT trading criteria caveat, and I keep pressing this because I want to be very careful not to lead people into just taking these trades willy-nilly when the strat ups aren't there, because trading out of the money puts and calls as a general rule without specific criteria, it's a losing strategy. If you do it a lot, you're going to end up losing money. They don't work except in very specific situations, which we're going to define here. So when trading out of the money options, any loss of momentum in the direction of the prevailing trend, whether through price compression, doesn't even have to drop, just compressing price or an early reversal will have a disproportionately negative impact on the options premium. The premiums are going to drop much faster on an out of the money put or call than they do on an in the money put or call. And because out of the money contracts derive most of the value from momentum and directional expansion, they decay far more rapidly under weakening conditions than in the money options do. This is why the criteria set up on these things have to be very specific. Okay, so in simpler terms, out of the money options demand uninterrupted momentum. You're looking for a stock to continue in your direction, one candle after another. You can get a doji in there, but you generally need uninterrupted momentum. Any pause, compression, or reversal erases the premium far faster than in the money contracts, and this is going to impact your exiting criteria. Okay. Okay. So what is OOMCAT? Out of the money catalyst. It's a structured method for trading out of the money options. Very specific. It works. I've been doing it now for a while. I've got plenty of testing behind this, and it works fine. But it's a structured method for trading out of the money options. It's designed to capture momentum driven by catalysts, right? And momentum that's driven by a catalyst. Momentum increases. You get an implied volatility increase in the stock options, and that, besides the price moving up, adds even more premium to the options, which really can give you some big moves. We're going to be using price action, volume, critical, relative strength, critical, and trend alignment. This is what we're going to be looking for. Right? Price action always important. In this particular case, volume is critical, right? And relative strength is also critical because we're going to get the best, highest probability trade setups if we're using relative strength, just like we do in the regular strategy. And trend alignment, right? We want to be obviously trading with the trend. It works best during high energy market conditions. Now, the market conditions don't necessarily have to be high energy, but the stock needs to be high energy, all right? The stock needs to be volatile and moving, all right? So this is what OOMCAT is. Okay, we're going to look for the catalyst. a strong catalyst dramatically boosts the probability. So how do we identify a catalyst? Well, stacked high volume candles is a catalyst. If you get 2 or 3 high volume candles, and the SPY super system now identifies high volume candles, white for bullish, yellow for bearish. If you get stacked high volume candles, that is a catalyst, right? That shows that institutions are coming in and they're pushing the stock up or down very quickly on volume. They're pushing it with volume. That adds to it. And that, along with the SPY super system indicators telling us that the institutions are in there, really gives us a really excellent catalyst. A gap up on a down market open. If you get a market that opens down 200-300 points and your stock is gapping up, that's a catalyst. You want to watch and make sure that it holds that gain. But if it does and continues higher, that's a good catalyst for stock, and vice versa. A stock that gaps down on an up market open also becomes a prospect. These are prospects now. You've got to wait for them to prove themselves after a few candles that the momentum is continuing and you're getting high volume continuing to that direction. Okay, news events impacting a stock. A news event will be a catalyst. The stock comes up, it comes up with news, pushes it up, pushes it down with high volume candles. That becomes a catalyst as well, right? And earnings move at the open is also a catalyst. Again, you've got to make sure that these things confirm that direction is going to continue. Okay, so those are the catalysts that we're looking for. This is the big one here, the stacked high volume candles. All right, the trend. What we're looking for here is in the software, we've got what's called a cascading up and a cascading down scan. Cascading up scan is bullish, 3 consecutive higher 5-minute candles. Get 3 candles that are stacking green, higher close on each of them. That's bullish trend. Bearish trend, 3 consecutive lower 5-minute candles. That's the cascading down scan, right? Bullish, relative strength versus the SPY on the 5-minute. How's the stock trading versus the SPY? SPY is moving sideways or down, and your stock's moving up. It's got relative strength. Bearish, vice versa. Stock that's underperforming the SPY. The SPY is moving flat or up, and your stock's moving down, stacking red candles. That's relative weakness. This is part of the trend. This is important. The bullish stock, if you're going long, the stock needs to be green for the day, right? We're not trying to take a reversal here off of a deep low. What we're looking for is a stock that's green, that's likely to keep going up. We want to be trading in the direction of what that stock has done today so far. Bearish stock is red for the day, right? So there's your bullish and bearish situation when you take the trade. You want to be trading green stocks long, red stocks short. And bullish, the current time frame momentum needs to be green or blue on the SPY super system. Current time frame momentum needs to be green or blue. Bearish, the current time frame momentum needs to be red or yellow. Obviously, this is bullish, this is bearish. We want the current time frame momentum to line up. We want the stock to be green for the day. We want the stock to have relative strength, and we want to have 3 high candles right here. They don't all have to be high volume, but we want at least to get 3 candles going in the direction to tell us we've got a trend, right? So bullish one, you've got 3 consecutive candles moving up. That's your bullish trend. It's got relative strength towards the SPY. If the stock is green on the day, and your current time frame momentum is green or blue on the 5-minute chart, right? There's the trend that you want to get for long, and of course the shorts would be just the opposite of that. All right, again, now volume. The current 5-minute candle, the candle that's being produced right now, when you look at that, it should be greater than 120% of the 50-period volume average for the highest probability trades. Now this is the criteria that we've got in the SPY super system for coloring out high volume candles. Greater than 120% of the 50-day moving average. The stock, if it's going up, it'll be white. If it's coming down, it'll be yellow. That's how if you look at the current candlestick, and all of your other criteria are there, and the candlestick is white for the bullish, yellow for the bearish, then you've got that criteria you need on volume. Okay. Now, higher probability entries occur when the price is near. If ideally we'd like to get in as the stock goes up or down below the VWAP, up or down below the 8 exponential, or up or down below the 15 EMA. I mean, this is the ideal situation to be able to enter a trade, just like we do for a SPY super system, where the stock is breaking above resistance or breaking down below support. But we're not going to get this all the time. But if we do get a setup, and that is also part of the criteria that you've got. In other words, you got all these other elements here met, the ones we just looked at here. Those are all met, and the stock is breaking above the VWAP as well for a long. That even gives you a higher probability, and it's excellent because you're going to have a very close resistance level or support level that could be broken, which means you're going to be able to exit the trade if it breaks below there. So this is what you'd ideally like to see, but there's going to be trades where we'll be enter some distance from the support and resistance levels. Okay, this is completely different than the SPY super system. The SPY super system, we don't chase. With the OOMCAT trades, we can trace. We can chase these stocks, and they can be moved away from these support resistance levels. And these at that point in time are not. If you're far away from when you enter the trade, these don't become an exit criteria. The exit criteria is going to come way before you come back down to these. Okay. Now, catalyst gets confirmation and an entry. This is what we're looking for. You get a stock, it's got a catalyst, all right? High volume candles, whichever it is. Then you look at the price action. How is the price action on the stock? Is it bullish? How has it been performing today so far? What's the volume look like? This is critical. You've got a catalyst, price action looks good. You've got good volume on the stock, right? With 150%, 120% of the volume in the last candle. It's got three stacked candles, and they all have decent volume. That's really important. Then you want to make sure the stock's got relative strength to the SPY, right? Very important. It's the daily trend. Is the stock trending up nicely today? I mean, is it green and trending up pretty nicely, and now it's breaking out? That's even better. And then you've got the EMA VWAP proximity. And again, this would be the ideal situation. If it's breaking through the EMA or one of the EMAs or the VWAP, that's the ideal situation. But it isn't always going to occur in the OOMCAT trades. It will always occur in the SPY super system trades, or it should. If you're taking the correct criteria, you should be getting in very close to the EMA, the 8 exponential or the 15 exponential. But this is if you can with the OOMCAT, if that's the setup for you, it's even better. Okay. All right. So exit criteria, and I don't usually have exit criteria in a SPY super system. They're very nuanced. But these are not so nuanced in the OOMCAT strategy. If you get a high volume reversal candle, in other words, you're in a trade and it's got high volume and you're moving up, and then you get a candle that's a high volume reversal candle. In other words, you get white candles moving up, and all of a sudden you get a yellow candle moving down that goes below the open of that white candle you had. Get out of the trade. Exit immediately on any high volume reversal candle. This is very important, because you're going to be losing premium so fast if it reverses on you. So we exit immediately in any high volume reversal candle. Take profits when the price approaches the target that you're looking for and the momentum begins to weaken. Once the momentum begins to weaken, this is the same situation. Now, it's not going to affect the option premiums as much as the reversal is, but they will affect the option premiums. If your trade hasn't got into the money at this point in time, this is when you're going to be taking it off, when that momentum is fading, right? You just basically get compression. You're going to exit on multi-candle compression, indicating a loss in directional energy. Stock's moving up, and then it starts to move sideways and drift up and down for 2 or 3 candles. Get out. You can come back and do it again later, but we're not going to stay in these things to hope that they recover. We can't stay in a trade like you can on a standard SPY super system trade or any of the regular trades that we take within the money options. We can give them a lot more room to breathe. We can't do that with an OOMCAT trade. We've got to get out. Now for longs, you're going to exit on a break below support, obviously. For shorts, you're going to exit on a break below resistance if those are available to you. If you're too far away from those, then you're going to be using one of these others. And also, exit when the SPY super system's current time frame momentum shifts from bullish to bearish for longs or bearish to bullish for shorts, right? So if the SPY super system goes from institutions buying to institutions selling and you're in the trade, take it off. Okay, you may be up money, maybe down money, but you don't want to hang around and wait for it to get driven down further. All right, so this is important, this exit criteria. And I don't usually go into a lot of details on exit criteria, but it's very important without of the money options, because the premium gets pulled out of those premiums so fast when the stock goes sideways or moves down. you lose it based on price, and you lose it based on volatility coming out of the trade. So very important, all right? Okay. Here's the exits again. Just I wanted to put this with high priority exit, immediate action, high volume reversal candle against your position, very critical. Break below support or above resistance, that's also critical. And the SPY super system current time frame momentum flips against your trade. Those are your high probability exits. Now momentum based exits, this would be kind of a warning. The price approaches a profit target and momentum weakens. It's stacking maybe white candles, bullish, 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 and then you start getting sideways moves, and you're up money, take the profits. Take the profits. Multi-candle compression showing loss of directional energy, right? If you get multiple candles compressing, showing a loss of directional energy, it's not moving up the way it was before when you took the trade. Get out. If you've got a profit in it, take the money. You can always come back and do them again. Structural exit. Okay, this is trend integrity. Loss of leadership versus a SPY. In other words, if your relative strength really starts to fade. Now this you can give a little bit of leeway to, right? Because stocks don't keep relative strength forever. But if it's starting to fade on a if relative strength starts to fade on a long, or relative weakness starts to fade in a short, you get much more, at that point in time, you want to watch price action. Just because you've lost relative strength doesn't necessarily mean it's not going to continue up, but you've got to be aware of the fact that it's losing relative strength and be prepared to get out. And again, failure to hold the VWAP, the 8 EMA or the 15 EMA after the catalyst move, if you get in close to that. If you're far away from that when you enter the trade, you're not going to stay in the trade when it goes all the way back to the VWAP, the 8 EMA, or the 8 EMA, or the 15 EMA. It's going to be too far away. All right. And then there's contextual actions, out of the money. This is specific risk for out of the money puts and calls. The catalyst follow through stalls. Again, that's basically compression. Out of the money options, they cannot survive hesitation, especially if you're way out of the money on these. We're going to talk a little bit about the specific criteria that we use for the options we select. But they can't survive hesitation. If you're still out of the money, now if you're in the money, it's a different story. Maybe they've moved up into the money after you took them. Then it's not so critical because they can still survive pretty well. But if you're out of the money on a put or a call, and the stock starts to go sideways, it's losing momentum, your options are going to start going down in price, right? And it can be pretty dramatic. The volume drops below the trend, indicating buyers and sellers are no longer supporting the move. This again is a couple of things you need to look at for the context of the trade. The hesitation of the stock moving up, moving sideways, the volume coming out it's not getting the high volume it was getting before, and it drops below the trend, indicating buyers and sellers are no longer supporting the move because the volume is dropping off. Obviously, you've got to use your own judgment as far as where you are in that trade, whether you should take it off at that point in time or not. But you've got to be aware of all of these exit criteria when you're going to get out of the trade. Some of these trades are pretty quick. If you see me in the room take some of these, you know some of them can be very quick, 5 minutes, sometimes less, sometimes 10, 15 minutes. But some of these stocks, when they're moving up fast, you don't need more than 5 minutes to generate a really nice profit. Okay, selecting the option expiration date and strike price. Okay, the OOMCAT is only going to use current week's expiration. We're not going to do these for next week. All right, I have looked at the possibility of doing them on Friday for the next week's expiration, but I haven't really tested it yet. Right now, I'm just using current week's expiration, all the ones we take. Out of the money option strikes, right? This you're going to be taking out of the money strikes. But the appropriate distance from the current price depends on the volatility profile of the underlying stock. So if you've got a very volatile stock like Tesla, or some of these stocks, APP, or these stocks that really move a lot, they can move $3, $4, $5 in a 10-minute period, then you can take further out of the money options on those, all right? Because they've got a lot of volatility. So that's why I say high volatility stocks can support strikes placed further out of the money. So you can get them cheaper. I mean, something like Tesla, even the out of the monies are not going to be cheap, but the further out you go, the cheaper they're going to be. But it's got to be something that's not completely off the wall as far as how far it can move. You don't want to take a Tesla option that's $25 or $30 out of the money. but you probably can get by with a $5 to $8 or $10 out of the money if it's moving fast, right? So high volatility stocks can support strikes placed further from out of the money. Low volatility stocks that don't move an awful lot, they should use strikes only 1 or 2 levels out of the money, 1 or 2 strikes out of the money, right? If you're trading one of the consumer staples, AT&T or Verizon or something like General Mills, Procter & Gamble, you want to just take a strike, depending on what the price is, maybe 1 strike, no more than 2 strikes away. And it depends on the price. You can look at it and see what the price is. You've got to use your judgment as far as which particular strike to take. But low volatility stocks, you can't go way out of the money, but you can go out of the money. A lot of times 1 strike out of the money is going to be really cheap, $30 or $40 a contract. And if you go down to like 3 strikes out, it'll be two pennies. That's to me, that's not worth it. I got to have some likelihood that the stock is going to approach the strike price, right? So high volatility stocks, you can take strikes further away from the money. Low volatility stocks, the strike should be closer, okay? And it's critical to recognize that the further out of the money you go, the faster the premium is going to decay, right? If you're out of the money, and if the further out of your money, the faster those things are going to go down, right? And because deep out of the money contracts are almost entirely momentum driven, they must be exited immediately on any sign of reversal, compression, or loss of directional energy. Really important. And again, what you're trying to do is get these in the momentum as they move, jump on the trend, ride it up with an out of the money. As soon as it starts to lose, profits taken. And a lot of times you're going to be up 25, 30, 40, 50, 60% just in 5 or 10 minutes if that move continues. That's what you're trying to catch here. Okay? All right. Again, selecting the option expiration date and strike price. The option selection must also account for liquidity factors. So if you're looking at an option that's 2 strikes out of the money, you've got to take into consideration the bid-ask spread. Tighter spreads are going to reduce slippage and they're going to improve the execution quality. If the spreads are too wide and the volume is too low, it's not something you want to take, because with a big spread, especially when you're just looking for a quick move, the spread's is going to eat up a lot of your premium. If it's 10 or 15 cent spread on a low price stock, that's going to be very, very detrimental. Now, if you're in something like Tesla or APP or something, a stock that moves really, really quickly, a lot of times you can sustain a 50 cent spread on the option. So you have to use your judgment as far as how volatile those stocks are. The contract volume and open interest, again, the higher activity at the chosen strike generally is going to produce more reliable fills and smoother price action. You're going to be able to get in and out easier if there's a lot of contracts been open today, and if it's got some good open interest, right? But you do need enough. If there isn't any open interest or not enough open interest, the bid-ask spread is going to be wide. You don't want to mess with those. So in short, choose an out-of-the-money strikes based on the volatility, prioritize liquidity, and manage deeper out-of-the-money contracts with faster, more decisive exits. Okay, and I know this is a lot to digest here, and I've been working on this for quite a long time, trying to get this in a format that I feel safe putting this out to people, that I've given them enough criteria that they can follow this, because I'm trying to keep them from just jumping into these trades willy-nilly, as I said before. This is a very specific, criteria-specific strategy, but the results have been really, really excellent, and I'll show you that in just a minute. Okay, so option selection. This is just color-coded. Risk critical, must evaluate first. All the OOMCAT trades use current week's expiration. If you don't have a current week's expiration, you're not going to take an OOMCAT trade on it. Further out of the money strikes decay rapidly. Remember this. They must be exited immediately on reversal or compression. And deep out of the money contracts lose value faster than near out of the money contracts. So avoid wide bid-ask spreads that create slippage and poor fills. This is the important risk critical options, or critical criteria for your option selection. Now, volatility-based strike selection. High volatility stocks, as we said, you can select strikes further out of the money because the stock's more likely to move faster and more. Low volatility stocks use strikes only 1 to 2 strikes out of the money. Okay, and match the strike distance to the expected catalyst-driven range expansion. Look at the stock price. Look at the chart. Does it look like that stock is, maybe it's been up there today? Maybe it's not going to run into resistance. Maybe it's got a likelihood of continuing on up, and you can say, okay, well, this stock's likely to go up another $2 or $3 before it runs into any kind of resistance. Take a look at your charts and see where it's likely to go to, right? So you're making a judgment on that. And again, liquidity requirements, prioritize the tight bid-ask spreads for clean entries and exits. Choose strikes with strong volume and open interest, and avoid illiquid contracts that distort the premium behavior. Right, so looking at your option chain is very, very important. Okay, again, here's the expiration rule. Always use current week's expiration. The short-dated contracts, they maximize our leverage and momentum sensitivity. That's why this works, because we're getting in cheap on a stock that's momentum that's likely to move in our direction. So we're getting in cheap and we can get out for a really high return. Faster decay reinforces the need for strict exit discipline from our normal trades. I have to be much more quick on these exits than I do in a normal trade. I can't give them room to go against me when they're out of the money. And again, behavioral awareness and out of the money. Out of the money contracts are momentum dependent. Hesitation destroys the premium unless they get into the money. Once they're in the money, it's not so bad. Deeper out of the money, faster decay, and stricter exit discipline. Okay, the further out of the money you are, the faster you have to get out of that trade if it goes against you. But also, if it's moving in your direction, you're going to make a lot of money on it. And always pair the strike selection with the SPY alignment and stock-specific volatility. You're looking for if the SPY is moving up and you got a stock that's bullish and you got relative strength in the stock, that's your alignment, the stock alignment with the SPY. And in stock-specific volatility, certain stocks are much more volatile than others. There's a lot of stocks that just you're not going to see any momentum in. They're just not going to come up on the list. It's not going to be something you're going to trade. All right, so in summary here, choose out of the money strikes based on volatility, use the current week's expiration, prioritize liquidity, and manage the deeper out of the money contracts with immediate exits on any loss of momentum. The deeper out of the money they are, the further out of the money they are, the quicker you got to take the trade if it starts to compress. If you're not that far out of the money, then you can give it maybe a candle or two, but you certainly can't withstand any reversals. Okay, so that is the whole OOMCAT strategy. All right, from in to out. I try to be very specific here about what we're looking for. All right, and again, rules to trade by: trade the best, skip the rest. This is no different. With this, we're going to be trading the best, skipping anything that doesn't meet our criteria. Same thing as we do for our SPY super system trades, for our swing trades. We're only looking for the very best here. So please don't just be looking to try to find an OOMCAT trade just to take an OOMCAT trade. Make sure the criteria are there. And again, our objective is not to make trades. Our objective is to make money. This is the whole point. And again, maintain discipline. Once you internalize this strategy, just like with the SPY super system strategy, you're going to maintain that. You're going to learn and follow that process, and then you're going to benefit from that. And you're going to remain patient. Wait for these setups. You know, we've covered a lot on this, and it looks like a lot, but it's really not. I don't think you're going to have too much trouble once you get these criteria down, finding these trades. I think you're going to find that they're, and I'll be pointing them out as the day goes on if I find some that look very, very good. Okay, and we need an edge. Well, we've got the edge here. We've got our SPY super system stuff. Now we got to lean on this. We've got a current time frame momentum. We've got relative strength and weakness that we're going to use. We're going to try to trade with the market trend if there is one. The SPY near support, sell near resistance is not as critical on the OOMCAT trades, because there's going to be cases where we're going to be further away from the support and resistance levels than we would be on a normal trade. Okay, and the SPY super system software, again, I just want to emphasize, this is the critical element in finding and trading the highest probability trades. We want this software to tell us that the institutions are in there, right? And I'm going to just look at the SPY super system here again. We've updated the SPY super system chart layout. We put the ADMA on there now. We've also got the high volume candles on there, white and yellow. White for bullish, yellow for bearish. Right. So here's the market. Here's for anybody who doesn't know about the SPY super system. Here's the market, the SPY super system indicators that runs on Thinkorswim. You don't have to trade on Thinkorswim, but this is what runs on Thinkorswim. This is my SPY super system right here. Here's your VWAP on the 5-minute chart, because this is what we'd be interested in for our 5-minute trades. The VWAP is the purple line. The 15 EMA is this green line right here, and the white one is the 8 exponential moving average. These are the support resistance levels for our SPY super system trades. And if you can get a high volume setup on something like this on an OOMCAT trade, then this would also be very useful, right? If you're getting an OOMCAT, like if you get an OOMCAT trade here, right? You see how it's blue right here and it's going through. That would be an OOMCAT trade if you were taking out of the money puts and calls. If you were doing a standard trade, you could take an in the money call there. All right. And now down here we've got the thing that really matters. This is the current time frame momentum. Green and blue is bullish, red and yellow is bearish. If you're going to be trading an OOMCAT trade long, just like a SPY super system trade long, this needs to be green or blue. And if you're going to be short, it needs to be red or yellow. You really have to have that. All right, so that's what you're using, right? And then you're using the high volume candles. So this is what the high volume candles look like. This is a CRML. I traded a OOMCAT trade on this. But you see that you get the white candles right here. So when you get white candles, this is telling you that there's a lot of volume coming in, and the institutions are buying. See the green candle, the green color? Institutions buying. Not only are they buying, they're pushing this up with high volume. So once I've actually got a candle here, here, and here. I've got 3 higher highs on this thing, and then I get a high volume candle. This is where I took the trade right there, right? And you write it up. Now you see how it's losing momentum right here? You're out. You're out of this trade right here as it loses momentum, and then you got a reversal candle. Even though it bounced off of there, you can't risk something like that. But even go down and touch the 8. Now, if you were in this with a in the money call, you know, that you could hold on to for a while, then you could wait for this to come back, because you get in right around the 8 exponential moving average. If it came back, you could stay in this trade if you had an in the money call, but you cannot do that with the OOMCATs. You've got to be out right here. This momentum is killing you right here. All right. All right. So here's some examples of some OOMCAT trades that I've taken. I'm going to show you the results that I've had with these OOMCAT trades. Right. This was DT. I took this just a couple of days ago. You can see how it's breaking out right here. It's green right here. I've got this stock actually moved up, bump, and actually had 3 higher highs, even though they was very small. And then I get this big white bullish candle, high volume candle right here off the 8 and the 15. I took it right here on DT, and I wrote it up and went right through the pivot point. I don't use the pivot point so much on these, because a lot of times with this kind of volume, they'll push right through there. And so I get another high volume candle, another high volume candle, a smaller high volume candle, and then I exit right here. It's starting to lose some momentum, even though they're still high volume. Now, this is a high volume bearish candle, but it's very small. I would not consider this a reversal candle, because it hasn't really reversed down, but I'm out of the trade anyway, because it's compressing too much here, right? So that's DT. That was one I just had, I think, last week. Right, this was Lucid. This was a beautiful short trade right here on Lucid. So we look at Lucid, and we're looking to the short side. Institutions are selling. So where's our entry going to be here? Well, we have a candle here, a candle here, a candle here, but we don't really have 3 lower lows. This is where I get into it. I had a lower low here and a big volume. Once I saw the big volume in this movement down, I took it right here, right? And I just rode this thing down, and then I got this. Now this is a borderline high volume reversal candle when it went bullish. So I took the trade off right here. Now, if you stayed in it, you would have been all right, but I don't want to risk that, because now we're compressing. So that's where I get out of the trade, right there on this, when it went from here, yellow to white. I'm out. Okay, and it was good for about 40%. So it was a pretty good trade. These trades don't last long, and when you're trading out of the money, believe me, these things can really push premiums up. Well, APP, this was when I traded twice. Now you can see this thing was moving sideways, and then it put this big volume candle in right here. So this is where I took it. When I get this big high volume candle to the downside, this is red. It's actually coming off the 8, so that gave me a little bit of confidence. And I took it out of the money call, puts in this thing. This thing is very expensive, this stock. All right, that's Lucid. I'm sorry. APP. These things are very expensive. So I took this trade as it broke down here, and I waited for this candle as it come through the 8 and 15, because I had a lower low here, a lower low here, so I took it right here on this high volume candle. See, it's yellow down here. Institutions are in there. I rode this thing down. Now this is a big move, all right. And this went from about 595 down to about 587. Well, because I stayed in this as a stay like this, and then I get up right here, high volume candle. Now it didn't actually reverse, but I didn't stay in it long enough because I had such a big profit in this at the moment at that time. I think I was up $300 or $400 a contract on this when it come down here. So I get out right there, and I had quite a few candles. That's actually a pretty good run on this APP, and I took it again later. Tesla, this was another nice one, and I took. Again, I'm looking for a bearish move here. All right, you see it's bullish over here. It's moving up, but it was red for the day. It's coming down here, breaks through the 8 and the 15. I got a lower low, a lower low. This is where I took it right here. As it broke below the 8, the 15, I take it right here on these high volume candles. The high volume candles continue all the way down. I get compression. I'm out of the trade. Right there. That's another on Tesla. This is a lot of money. I mean, this is a lot of money. This was like 442 down to about 438 or something like that. So that's a big trade. But again, you want to be out when this compression occurs, especially if these haven't gotten into the money yet. I don't remember if I was in the money or not, but I get close to the money on them. All right, it's Tesla, and his was Adobe. This was a very, very quick trade. This was when it opened in the morning right here. I didn't take it there. I waited for it to come down, but now I took it here. I got 3 lows. I took it right here because it was still another high volume bearish candle, and I wait to see how far I am away from the 8. So I took it here, and I get out right here. Get here in here. I get out as soon as I put a doji candle in right there. It's still red, but I'm out. And again, here's a high volume reversal candle and a bump up through the 8. So I'm out of it right here. These are fairly quick trades, but I think you can see the colored candles helps a lot on seeing these things. All right, this was ISSC. I traded this twice last week or the week before. This was in the morning. I took this one on this big, see higher, took it right here on when this candle was forming. I wrote it up right here, and I get out as soon as it turned yellow here. Could have got another candle out of it, but I didn't. I wrote it from here, about halfway up this candle, from 1950 to about 2050 or so, about $1 on the options. But remember, that pushed up the option prices. I think I paid somewhere in the neighborhood of about 75 cents a contract, and I get out for about $1.25. These are big moves when you get the volume in here, and it's pushing the implied volatility up as well. Okay, now I've got some examples of the exit criteria to use, so you can see what they look like on a chart. All right, so this is what's called a high volume reversal. This was APP. See, it's coming down here. Now, there's a high volume candle right there, but it's a doji. But this would definitely be an exit right here. That's a high volume reversal candle. You see how it's white and it's moving up, and see how it followed through after that. You don't want to be hanging around, especially if you're in this trade. You've been in this trade, you're probably up good money. You don't want to risk it because it can bleed those premiums off very, very quickly. Right? That's a trade on a high volume reversal. This is a compression exit. Tesla coming down, compression. Get out of the trade. Take your money. As soon as you start getting compression like that, you want this downward move to continue. Remember, this strategy makes its money on momentum in the same direction. Once the momentum is losing, it's going to kill your premiums. You want to get out and take it while you can. Okay, and again, you do have to be fairly quick on some of these. But if you're only just trading one at a time and you're looking for these things, you'll see them. And if you've got the SPY super system up, you'll see all the volume. You'll be able to tell. You can see how the volume petered out here. APP, this was a big high volume reversal. This is an APP trade I took here, and it came down, put in a doji, came down, bounced, and boom, high volume reversal right there. You don't want to be hanging in the trade when this happens. You might just be breaking even or something at that point, but you do not want to be in this trade anymore after that. Even though it was still bearish here, you don't want to fight these candles. You can see what you get. You get this move to the upside. All right. Okay. So that is the OOMCAT trading methodology strategy that I've been working on for 2 months. I started it back in November. I ran the trades up through it last week, I think 15th or whatever it was, on Friday. And the trade summary on the trades that I took, and remember, I was learning on some of these things. I stayed in some of these trades longer than I should have because I didn't have I didn't have my exit criteria as well defined as I do now. But even at that, I had 146 trades, 130 wins, and 16 losses, right? And I would have had smaller losses if I had my exit criteria defined as I do now. Win rate 89%, profit factor is 5.04. This is a huge, huge profit factor on these things. This is really a big profit factor. Anything over 3 is a huge profit factor. 5.04 on these 146 trades. And when I calculated putting 500 into a trade. Now there was a couple of trades where you had to put more than 500 because the option prices were more than $500. But for the most part, all the trades, if the options were 50 cents, I got 10 of them. That's the way I did this, as opposed to 2,000, which I used to use. I use on the regular ones. I use 2,000, and I could use 2,000 here, but I'm trying to be conservative, and I'm trying to put the risk on the trade a little bit less. But even at that, $500 invested in these trades produced a little over $13,700 in profit. That's a pretty big profit for $500 invested in a trade in just 2 months. And again, if you invested 1,000, that would have been 26,000. So this is what the performance report looks like. Again, 146 trades. That gives me enough to justify basically sharing this strategy now. All right. I was hesitant to do it until I had enough trades behind me to think that it worked, and I wanted to get the entry and exit criteria down. So that's what I've done, and I think I've got it down pretty good. Again, they can be very tricky, so you've got to be very quick on these things, but follow that exit criteria because it actually would have improved increased my profitability on these trades. Okay. And again, here's what we do in the room for those folks that aren't in the room or aren't a member. We do straight calls and puts. We do straddles and strangles, non-directional trade. We do debit spreads using weekly option expiration. Time spreads over earnings. This is a calendar spread to capture volatility crash, non-directional trade. Weekly ATMs. This is a strategy where we sell puts against a neutral to bullish stock week after week after week while holding a longer dated long put out in time to protect ourselves. And we do credit spreads to capture premium over a few weeks. And then now in the SPY super system intraday trading, we've got the SPY super system for very high probability trades. Again, to catch the SPY, the Qs, IWM futures, and I even use it on stocks. But these would be in the money calls and puts. You can give these things a little bit more time, but your cost to get into the trade is going to be much higher than the OOMCAT trade. And here's the OOMCAT for high momentum, high volume trades. This is a new one. This thing is I've worked pretty hard on this and spent a lot of time. If you're in the room with me, you've heard me talking about it a lot, and I've tried to share it with you as I went along and developed the rules. But I feel like I've got it down pretty well right now. I think we've got here is the criteria. It's good enough for folks to use. And again, you have to be able to do day trades. But again, when they change this 25,000 down to 2,000 PDTs, there's going to be tons more people trading. And this you have to think about as a good thing because it's going to take a lot more people who have no idea what they're doing, not to be cruel, but a lot more day traders coming in there who don't have any idea what they're doing, who we're going to be able to take advantage of. And that's what, listen, we're trading against other retail traders. That's how we make our money. This gives us two really strong intraday trades strategies to do that. And as more and more people come into intraday trades now because they're going to have, they won't have the account requirement that they have right now, you're going to have a lot more people in there making these trades on these stocks. It's going to give us it's just going to be a big help to us, Okay, so that's it. And again, this is the alert service. If you haven't seen this or been in the room or know about the alert service, we just do it for day trades and short-term swing trades. We do it for traders who can't watch the market all day. And again, you get alerts on the highest probability trade setups, which are trades that have institutional involvement in it. Okay, so that is the OOMCAT trades. And I hope you find this useful. I spent a lot of time putting this thing together. Not just putting it together, coming up with the criteria for the OOMCAT system. It was really important. I knew I could get them to work, but I really had to get the definition of the criteria down. But I feel like the criteria is very solid here, And I think this is a great methodology and a great strategy. So I look forward to seeing you folks in the room. We'll talk about this on Tuesday. This is a holiday right now. It's on the 19th, but we'll be back in the room on Tuesday talking about this. And I'm sure people will have some questions. But again, thanks very much. Trade well. Look forward to seeing you in the room.